So Canadian bank stocks, I've got a early holiday gift for you this week. I'm going to be going over a release that I typically send out only to our premium members, which is discussing the overall earnings of the banks, the valuations, the provisions for credit losses, the overall earnings growth, and just some quick commentary on each bank this quarter. This is my way of saying thank you for being a loyal watcher, a loyal subscriber, a loyal reader. If you're part of the newsletter, not part of the newsletter, you want to head down to the description below and sign up. You're going to get a free report on 3 stocks I really like for 2025. And you're also going to be able to get some information on our promotional offer we're going to be offering in the new year for premium. It's going to be some of the best discounts we've ever offered on the platform, and you cannot get those if you're not on the list. So let's dive right into the video and go over each of the big 6 banks, go over their earnings, their valuations, their provisions, their dividends, things like that, and just overall give my thoughts on the businesses and which bank I feel is the best opportunity today. So as always, like the video, subscribe to the channel, and the one thing I will mention is this will likely be my last video before Christmas. So I'm going to be taking a bit of a break from the channel. I've been pumping out a lot of video content as of late, and I'm going to just be spending some time away from Stocktrades, away from premium overall, and I'll be back after the holidays in full force with more great content. Also, everybody, I had planned to make this a full face video, as you can see from the start, but my camera actually ended up breaking midway through. So yeah, I just had to turn this into a screen share video, and I hope you still enjoy it. So the first bank I want to speak about is Bank of Nova Scotia. So pretty much after being, one of the worst performing banks in the country for a very long time, Scotia is set to close out the year in the middle of the pack. I believe it's below Royal National CIBC, but it is well ahead of a bank like TD or BMO after they've had some pretty rough years. So the bank is up around 32% on the year. Keep in mind, I would have actually made this on December 8th. So these returns can vary a bit, but the main point to drive home here is the banks have done very well in 2024. So headline numbers last quarter, they were relatively in line with estimates, but they missed revenue and earnings by pretty much negligible amounts. I mean, when we looked at the quarter, they missed earnings estimates by 1.73% and revenue by 1.19%. I would actually consider it to be a pretty good quarter for the company. I mean, the company's Canadian net income segment, it's up 34% on the year, while revenue was up 5%. Considering the company's expenses rose by 4%, we can pretty much attribute the vast majority of this growth to a reduction in provisions for credit losses. So, I mean, the main positives I took from Scotia's quarter: stabilizing provisions for credit losses, a large reduction in performing provisions. This is probably a result of declining rates in Canada. Obviously, performing loans are loans that the bank, it's still getting paid, but the bank expects could go unpaid. So it's not really all that surprising to see a decline in interest rates and a reduction in performing provisions. So those loans that might have been at risk during the ultra high interest rate environment might not be all that at risk now that rates have declined. So the main negatives from the quarter: despite a 34% year over year boost to earnings per share in its Canadian arm, overall earnings declined by 0.2%. So the company is having difficulty growing overall, and the 30% year over year gains in its Canadian arm were largely due to provisions for credit losses. So ultimately, I mean, they still need a bit of an operational turnaround, because you can't just fuel earnings growth through provisions. Eventually, you're going to run out of room there. So Royal Bank, they are one of the best performing banks in 2024. As we can see by the chart here, they're up 38% on the year. And I mean, it was just another rock solid quarter from Royal Bank. They are a Canadian foundational stock over at Stocktrades Premium. They have been since we started that list back in, I believe it was 2019. Earnings per share, $3 topped expectations, and returns on equity came in north of 15%. I believe a lot of the big banks are struggling, with returns on equity in like the 8-9% range. The company's acquisition of HSBC is driving a lot of the growth at this point in time. I mean, it had expected to take a couple of years to realize, around $740 million in synergies. Thus far, it's already realized 55% of those. So it was a very solid quarter. It was a very solid year for Royal Bank. I mean, the main positive, the company's firing on all cylinders in pretty much every aspect of the business: personal and commercial banking, wealth management, capital markets, year-over-year growth, all in the mid to high teens. If we isolate out HSBC, it's not as good, but it's still some of the best growth rates among all the banks. The main negatives, I mean, the company reported one of its higher quarter-over-quarter growth rates in terms of provisions for credit losses over the last few quarters. However, considering the company has some of the best PCL ratios, which would be the total amount of provisions for credit losses relative to their total loan book. I think the market generally shrugged it off. I mean, they have a lot of room. I believe their PCL ratio is like almost half of some banks that are really struggling, like BMO, like TD Bank, things like that. So BMO, this is one of the weaker Canadian banks in 2024. You're going to see, since October, it's gone on a sharp rise. It's up 17%. As mentioned, this post is about a week old now, so I'm not sure what it's doing right now, but there's definitely been a significant recovery due to provisions somewhat normalizing. I mean, BMO got obliterated on rising provisions. Investors tend to get scared with situations like this when they see provisions ballooning. They don't know when it's going to end. I mean, it has normalized on that front. So as a result, the stock has gone up 25 some percent since the September, October lows. I ended up selling this company it was either late 2023 or the start of 2024. I sold BMO and TD Bank just on this provision news, and with TD, it was the anti-money laundering news. But ultimately, it's done quite well over the last month and a half or so, but it's really struggled in 2024 relative to the other institutions that are doing well. From a headline number basis, they topped expectations. They topped revenue expectations, but earnings per share came in well below the $2.38 expected. All that said, the company did jump in price post earnings, and that was primarily from commentary in the conference call. So management effectively said that provisions should be stable from here. They said that, the rising provisions have likely all been realized, and it should be able to stabilize from here, which is exactly what investors wanted to hear. So the main positives from the quarter, I mean, it was a relatively poor quarter. However, the CEO did mention that the bank's credit issues are contained now and the environment will be better in 2025. So the main negatives, obviously the company's provisions, which I'll get to that, are still among the weakest of the major institutions and are taking quite a big bite out of earnings. They will need this to normalize through 2025. So let's get into TD Bank. So TD Bank, they reported arguably the weakest quarter out of the big six. The anti-money laundering issues are really impacting this company right now, and they're looking to, be impacting this company at minimum over the next year. I'm expecting the AML issues, to fully extend into 2028, 2029. We can see the price. We're talking about a loss of 9.68% on the year, when most Canadian banks earned anywhere from 30 to 50%. So this is a gigantic underperformance, and it's really not all that unexpected. I mean, they've had a relatively rough year. They posted a very rough quarter recently. So they exceeded revenue expectations, but this was primarily due to the sale of its Schwab shares and not operational results. On the earnings front, it reported $1.72 on the quarter, which was below the $1.80 expected and down 5% year over year. This isn't a huge miss on earnings, but what the company mentioned is that it will be very hard for the company to grow earnings in 2025 because of the anti-money laundering issues. So effectively, you're going to see no growth from TD Bank in 2025. And when they say it will be difficult to grow earnings, to me, that means that flat earnings are the best case scenario. We could see declines in earnings per share. I mean, main positives from the quarter, despite the company's rough results, provisions are starting to normalize. This is key because if the company was going through AML issues and provisions were accelerating, I mean, the stock price would be a lot lower than it is. And the main negatives, obviously, the company's AML issues and overall operational struggles have caused it to suspend all guidance and outlook. This is very rare for a Canadian bank to suspend guidance. I mean, among the ones that issue guidance, for them to suspend it, that is notable. There's no question about it. So pretty rough quarter from TD. When we go to National, they've been one of the better performing banks, 35.2% in 2024. But it was a relatively soft quarter, and it was one of National's first soft quarters in quite some time. So revenue and earnings hit targets. Another interesting note as well, out of all the major banks to publish medium-term financial targets, National Bank was the only institution to hit all those targets in 2024. So the underlying numbers are strong for National Bank. However, the market likely expected, stronger because it faced some pressure post-earnings. And another element of this might be that the company reported a 19% year-over-year growth in impaired loans provisions for credit losses. So, I mean, strong quarter from National. It's one that I hold as well. It's one of my larger bank holdings. I mean, the main positives, hitting 2024 guidance was huge. Something a lot of banks had difficulty doing. They still remain one of the fastest growing institutions in Canada out of the big six. The main negatives here, with the company's current valuation, it will need to ensure the slower growth in its personal and commercial banking is a one-off, or is at least short-lived, or, we could continue to see valuation pressure. Now, finally, CIBC. So this bank absolutely killed it in 2024. We can see returns of, 53, 55% on the year. And the main driver of this was a reduction in provisions for credit losses. So we saw CIBC in 2023. They were reporting crazy high provisions. The stock price was taking a beating because of this. And what it looks like now is the company kind of overestimated these provisions, and now they're scaling them back in a big way. So this is having a big impact on earnings per share, and as a result, its stock price has just absolutely ripped in 2024. It's now posting the best provision numbers out of any 6 banks, which is vaulting earnings. So earnings per share came in at $1.91, well ahead of estimates for $1.78. So in addition to provisions vaulting earnings, the company's Canadian arm is reporting very strong results with high single-digit revenue growth and double-digit earnings growth. I mean, this is probably the best out of any major institution in Canada, no doubt. So the main positives, again, the continued decline of provisions, putting the bank in a position where earnings growth is accelerating, not only due to strong operations. This bank is operating well, plus quarter-over-quarter declines in PCLs and big declines in year-over-year numbers. So the main negatives, there wasn't much not to like out of CIBC. I don't like this company overall because of its Canadian exposure, but I do have to hand it to them. I will give credit where credit is due. They've absolutely killed it in 2024. It's going to be interesting to see if they can keep that up in 2025. So we've gone over the individual bank earnings. If I were to rank them from best to worst in terms of overall earnings, I would say CIBC would be up there, number 1. I would say Royal Bank would be number 2. I would say probably Scotia, its recent quarter, number 3. Then we go National, number 4, BMO, number 5, and TD, number 6. TD at number 6, that's a number 6 by a pretty big long shot. They're really, really struggling right now. Now I want to move into the KPIs, the key performance indicators that I tend to track for Canadian banks. And these are going to be some pretty handy tables so that you can kind of get some insight as to the direction the banks are going moving forward. So first, earnings. So we have expected earnings in 2024. So the top row of this column here is the earnings they were expected to earn at the start of the year. So this would have been analyst estimates that I kept track of at the start of the year. Then the second row would be their actual earnings, their actual reported earnings in 2024. And then the bottom column here would be 2025 expected earnings, what they're expected to earn next year. So when we look to the expected earnings and the actual earnings, I've highlighted the banks that actually topped earnings expectations in green. We can see National topped earnings by about 2 cents, Royal by about 4 cents, CIBC by about 14 cents. But then when we look to the other institutions, the ones that are in red, they're the ones who missed earnings expectations. For the most part, TD Bank, they missed by 10 cents, Scotia by 3 cents. Bank of Montreal missed by a wide margin. That is because those provisions are very hard to predict. They came out of nowhere, and as a result, it missed earnings by quite a wide margin. And when we look to 2025 expected earnings, we can see that for the most part, the banks that are expected to grow earnings are the ones with heavy Canadian exposure. We look to National, $10.39 to $10.75. We look to Royal, $12.09 to $12.95. We look to CIBC, $7.40 to $7.76. Then we look to the banks with heavy U.S. exposure, heavy international exposure, and which, ones that are going through a bit of difficulty right now. We see TD Bank, as mentioned, flat earnings. Analysts don't expect them to grow at all. We see BMO, who's expected to take a big hit in earnings per share, likely because of elevated provisions again. So you're going to see a big decline in earnings. Well, they predict a big decline in earnings in 2025. We look to Scotia. They're expected to grow earnings, so they're expected to do quite well. They're going to grow it at the same pace as the Canadian exposure banks. Keep in mind the red. It's only in red because it missed 2024 expectations. 2025 is expected to be, at least from an analyst perspective, a pretty good year for Scotia. But Scotia has disappointed in the past, so it'll be interesting to see what happens. So overall, if I were to sum up earnings, it would have been Canadian banking segments that drove a lot of this growth, and it's going to be really interesting to see if that can keep up in 2025. The Canadian economy is relatively weak, and I'm not particularly bullish on it whatsoever. Next up, let's go over valuations, and this is probably the most important segment of this video because I'm going to tell you right now, the Canadian banks, at least from a historical basis, are very expensive. There is absolutely no questions. So when we look to the trailing price to earnings ratios for all the Canadian banks, I'll zoom in on this chart for a bit here. We can see trailing price to earnings ratios, and then we can see 10-year average price to earnings ratios. So this 10-year average PE would be the historical average that the market has been willing to pay for these banks. We look to national historical averages 11-ish. They're trading at 12.4. We look to Royal Bank, which is arguably the most expensive bank out of all the institutions. I mean, there's no doubting that. 15.86x. Averages are 12.3. So this company is trading at a big premium. I mean, its forward price to earnings of 12.56 is higher than its trailing 10-year averages. So there's no doubt Royal, it's expensive right now. So one thing you're probably going to notice here with Toronto Dominion Bank is it looks like it is just as expensive as Royal on a trailing basis. But the one important thing we need to understand here is that Toronto Dominion has a lot of anti-money laundering issues impacting trailing earnings that are not expected to impact forward earnings. And this is why we see the bank, it is actually trading at the cheapest forward valuation multiple out of all of the big six banks by actually quite a wide margin. We can see 8.73x forward earnings, whereas Scotia is around 9.88. That would be your next cheapest option. Now, from a valuation perspective, do I believe that TD Bank is the most attractive bank moving forward? I would argue no. It is the cheapest, yes, but it is also expected to post the lowest growth. I mean, if we come back up to this earnings section here, we're talking about an actual decline in fiscal 2025 earnings per share. Now, could this company be a long-term buy and hold at attractive valuations right now? I mean, if you just plan to buy it and hold it for 5 years and just kind of hope the AML situation gets resolved quickly, the asset cap comes off quickly, yes, I believe you're getting a very good price right now. However, over the midterm here, I can't exactly see TD Bank outperforming all that much. There is a chance, considering valuations are this cheap, if it comes over and above what is expected of it, it could actually end up being a strong performer. But this isn't a situation like Bank of Montreal where its provisions for credit losses just need to kind of normalize. This is a company that actually has its assets capped. It cannot grow its U.S. assets. In fact, it's having to sell off its U.S. assets in order to create a bit of a buffer so it can still serve customers south of the border. And that is a bank that has a lot of U.S. exposure. So overall, I believe the banks are... I would argue to say that they're overvalued at this point in time. Do I still hold them? Absolutely. I still hold National. I still hold Royal. I still hold Equitable. I mean, I did end up trimming my banking positions because I do believe that this run-up, it's likely not sustainable. I mean, we're not going to see a big run up next year. I mean, maybe we do, but I highly doubt we see 30, 40, 50% returns from the banks, in 2025, 2026. They're likely to either see a bit of a correction or kind of gradually grow into these valuations. But I do think the big money in terms of banks was made in 2024. However, I would love to be wrong because I still do own these institutions. I just feel like they're a bit expensive at this point in time. And if I were to say which bank is the most attractive, I would probably say National. I do expect them to grow a little bit faster than companies like Royal and CIBC, just because CIBC, a lot of the earnings growth has been due to provisions as of late. So, I mean, if you were to force me to answer what I would believe is the most attractive bank stock, despite being, at a higher multiple than many of the other ones, I would say National. And obviously, I'm a bit biased there because it's my largest bank holding, but it's also my largest bank holding because of that exact reason. So when we go down to the next KPI, which would be provisions for credit losses, I have their total provisions in the recent quarter. I have the quarter over quarter difference, and then I have the total PCL ratio. So quarter over quarter difference. Why is that important? More important, I believe, than year over year. Well, we want to see quarter over quarter provisions stabilizing. And the reason why year over year is not really all that accurate is because the economy can be in a much different position on a year over year basis. Obviously, in the fourth quarter of 2023, we were sitting on record high interest rates. It was a big issue, and now we're seeing those policy rates declining. So the economy is in a different type of position that it was a year ago. And we're also seeing a lot of these banks start to stabilize in terms of provisions. So we see TD Bank 3.4% quarter over quarter increase. I would see that as generally pretty good. Same with Scotia, negative 1.9% quarter over quarter increase. That would show that they're starting to normalize. They're starting to be able to predict with relative accuracy, at least in their opinion, the impacts on the overall economy. When we see CIBC, and this is one reason why CIBC has done so well over the last while, we're seeing a negative 13% quarter over quarter provision reduction. Now, when we come down to the total PCL ratio, which would represent the total PCLs relative to their entire book value. So, if we come to a company like TD Bank, total PCL ratio of 0.4 would mean for every $100 in loans TD Bank has, 40 cents of them are assigned to provisions for credit losses. So obviously we want to see a lower ratio here. And we're seeing National Bank still comes in best in class at 0.27. However, they've seen, a relatively big uptick in quarter over quarter provisions. And it's going to be interesting to see where this goes moving forward. If this is a one-off or if it continues to accelerate, we could see more pressure on the stock price, and we could see this ratio, this 0.27 ratio, get up, relatively in line with the other banks. Obviously, BMO 0.91, that is not the best. Obviously 67% increase in quarter over quarter provisions and 1.52 billion total is not the best either. As mentioned, their management said that the situation is now contained. It'll be interesting to see if it is contained. And, CIBC 0.3, I would argue, is in the best position from a provision for credit loss standpoint at this point in time. Yes, it's higher than National, but also it's trending downwards while National is trending upwards. So provisions, the clear standouts here, BMO and Royal Bank. However, Royal Bank is in a much better position. You can see it. It's almost a third of the total PCL ratio. So obviously, it has a bit more of a buffer, whereas BMO reporting this huge increase, it's ultimately not that good. But overall, the provisions for credit losses for the banks look a lot better than they did at this point last year. And the final thing I want to go over is the dividends. So we're looking at, for the most part, the bank stocks dividends they're healthy, they're fine. There's no major issues here. However, the only two stocks that I want to focus on are Scotiabank and TD Bank. When we look to National, Royal, CIBC, BMO, they all made relatively reasonable dividend increases. We're looking at National and Royal, who raise semi-annually, so these rates are going to be pretty close to double that on the year. We looked at BMO, who raised 5%. This is typically lower than BMO has raised in the past, but obviously with the provisions for credit losses, maybe they're taking a bit of a cautious approach. CIBC, 8% dividend growth, very solid, very good payout ratio. Surprisingly, CIBC used to be the highest yielding bank stock. It's, one of the middle of the pack, actually. If we're talking third out of six companies. This company typically has always yielded north of 5%. So the two companies, TD Bank, Scotiabank. Scotiabank has not raised the dividend for a couple of years now. It will lose its aristocrat status. So 73% payout ratio. This is something that you never want to see the banks trade at. Typically, they hover around the 50% range, 40 to 50% range. That is typically what the banks will always target in terms of total payout ratios. TD Bank, on the other hand, they're at 81%, but this is a little bit different than Scotiabank's 73%. Scotiabank's 73% is mostly, just due to operational difficulties. Earnings haven't grown that much over the last few years, and as a result, the payout ratio has risen, whereas TD Bank is more of a situation where trailing 12-month earnings are impacting the payout ratio because of anti-money laundering issues. So this payout ratio will normalize. Will it go back to the 40 to 50% range that the other banks trade at? I doubt it. However, I do believe, the company raised the dividend 3%. Should they have? I mean, a lot of people can debate no, because, flat earnings growth for next year, already a relatively tight payout ratio. I would say if we isolate out the anti-money laundering issues from this 81%, it's still higher than historical averages. But also, this is half the dividend growth of historical averages, less than half. So 3% range seems pretty reasonable. I mean, they want to keep that dividend growth streak alive too. And a raise in this quarter was pretty much mandatory to do that. But overall, the dividend, I would say that is in the worst shape would be Scotia. TD on the surface looks like to be in the worst shape, but I expect those earnings to normalize moving forward. So everybody, that is it for the video. I really hope you like this post. It is a in-depth research report that I go over every single quarter. So premium members get this every 3 months, giving them a bit of an update on the Canadian banks, the Canadian economy overall, and it's definitely one of the most popular releases for our premium platform. So as I mentioned, bit of a holiday gift. I wanted to give it out to everybody. If you are interested in joining premium, we are going to be having a huge New Year's sale. You're going to get into the platform. You're going to get our 2025 Canadian and US foundational stocks, the Discord, the model portfolios, the Q&A, all the bull list stocks. So if you want that, the sale is not going to be live right now, but if you head down below in the description, sign up for the newsletter, in which you'll get a free report from Premium as well. It'll keep you kind of in touch with what we're doing and when we're planning to launch this, which would be shortly after Christmas. So you cannot get that discount unless you're on the newsletter. So you're going to want to sign up for that. As always, everybody, head down below, subscribe to the channel, like the video, drop a comment down below. Let me know what your favorite bank is and which ones you own. And we'll see you next time for more great Canadian content.